Okay, we're just about 20 minutes away from the start of trading, and U.S. futures are right now pointing to a positive start. Maybe we'll see a continuation of the rally that last week netted the S&P 500 its best weekly performance of the year. And keep in mind the TSX has been on a winning streak recently, the longest actually since April of 2023. So after the rough start to the month, we've seen investors plowing back into the stock market, but that volatility at the center of the downs and now ups is something our next guest thinks could continue. It's one of the reasons why, as an American investor, he's increasingly looking for opportunities outside the U.S. Tyler Ellegard is a portfolio manager at Gradient Investment and one of our regulars. Tyler, good to see you. Thanks for the time.
Thanks for having me back.
Sometimes people say, look, August, it is inevitable. It can be choppy. But is there a sign of something else that you're seeing right now?
Yeah, I think there's a lot of uncertainty just on the macro landscape for the United States right now. We've got the Fed, who is anticipated to cut this September. Now the question of how many basis points do they cut in September? We've got different economic data that shows some growth, some weakening. So I think there's a lot of just uncertainty right now. And we're also headed into the election season here in November. Those ads are starting to pick up quite dramatically. And so between the economic landscape and the presidential election, I think investors are just cautious right now.
And so that is a recipe to you that would suggest maybe the U.S. stock market could be turbulent going forward?
Yeah, we think that the market really doesn't go much from here. I think you're just going to see a bunch of choppiness until the year end. Maybe once you get to the election and we know who the next president is going to be, maybe then the market can settle down and do what it normally does. But I think until then, we're going to see some choppiness regardless.
Okay, so I mentioned that because of that, you're looking abroad, and there's a range of companies you're watching. Now, actually, it's interesting. Within North America, you're looking at a company like Walmart, but the operations in Mexico. Everybody's been talking about how Walmart in the U.S. has been crushing it recently, but Walmart's Mexican operations do trade as a public company, and it's a stock you like. How come?
I do, and I think part of it is Walmart's had that the U.S. Walmart has had that solid execution, and Mexican Walmart or Walmex, if you want to call them, they're really in the lagging process right now of what Walmart had done operationally a few years ago, right? Walmex has invested in the e-commerce, and now they're investing in new stores and trying to ramp that up. And so not only has their gross margins begin to rise because of that e-commerce business, I think this quarter previously was a discount or a disappointment because we saw a lot of uptick in operational costs, which kept some of their margins flat for the quarter. But I think as we move through that, a lot of that increased cost was just initiatives for new stores and working on those efficiencies. And so I think that's a short-term problem for Walmex. And so as they get into next year and work out those efficiencies and those initiatives begin to go away, I think not only their gross margins, but all their operating margins start to increase. And then when you look at it from a valuation perspective, they're at a pretty steep discount to US Walmart right now. Typically they trade anywhere between in line to a slight discount, maybe 5-10%. But right now they're at about a 2 standard deviation discount to Walmart. They're trading at 18 times next 12 months earnings, whereas US Walmart's trading about 28 to 30 times. And so I think you can get not only earnings increases in the future, but also some re-ratings of the stock going forward. Okay,
so that's some helpful context. We've also talked a lot about China. Sometimes, to your earlier point, like what does the political landscape look like come November? What does that mean in terms of the relationship with the U.S. and China? But there's also these mixed signals we're getting on what the demand picture out of China is, and that certainly impacts all sorts of things. It impacts what's happening in the oil market. Technology has generally been a pretty hot sector this year, but in China, maybe you see more mixed performance. JD.com, which trades in New York, is another name you're watching right now. How come?
Yeah, it's a fantastic e-commerce business. The stock, just like every other Chinese stock at this point, has pulled back quite significantly, more specifically on the technology e-commerce side, and JD is certainly in that camp. But I think when you look at the uncertainty of the political regime currently in China. I think a lot of that is built into the valuation of JD.com currently. And so the stock is only trading at a 7.5 times next 12 months discount or PE valuation. And so I think, if we look at the stock from a growth standpoint, revenues have been disappointing because of the Chinese economy hasn't been growing as much. And so spending on the high ticket price items on JD have not been as frequent as they have in the past. And so I think that's partly why the stock is trading at a discount, but also the regulatory situation. But despite all of that, they still get high single digit revenue growth, and margins have been fantastic on the company. They've cut back on promotions and subsidies, which has led to higher gross operating margins as well as higher earnings per share. And so you're getting EPS growth in the mid double digits right now, or mid teens, I should say. And so for a 7.5 times valuation at that double digit growth, I think is a perfect opportunity, and which is why we added it after their quarter on Friday last week.